In this video, we're going to discuss the structure of spin-offs, split-offs, and split-ups. So spin-offs, split-offs, and split-ups can be either taxable or they can be non-taxable. And to be non-taxable, they're going to have to qualify under Section 355 and Section 368 of the tax code, and you'd likely see them as a Type D divisive type of tax-free reorganization. But I'm just going to talk about the basic format and how they're set up. So if you hear about a spin-off, what it is basically, so you've got one corporation, so we'll call this the distributing corporation. So I'll just do DIST here. This is the distributing corporation, and they've got shareholders. We'll say there's ECI shareholders. This is Electric Cars Incorporated, and they've got the shareholders are over here. So this is the distributing corporation, and we call them distributing because they're going to distribute some of their assets. They're going to distribute some assets to a subsidiary, a controlled corporation. So they control this subsidiary. Now, it could be that the subsidiary already existed, or it could be that they just created this subsidiary. It doesn't matter. But the distributing corporation is going to distribute some of its assets to this subsidiary. So let's say that Electric Cars Incorporated, they're going to distribute some assets they have regarding a flying cars division, and they're going to create this flying cars subsidiary. And they might be doing it because they think, hey, you know what, we make electric cars, and these flying cars, this division is just too risky. We really want to separate it out. So they're separating basically from this distributing corporation is separating out like a division or a group of assets. They're putting them in this subsidiary, right? So now what's going to happen is they're giving the assets to the subsidiary, and then they're going to receive stock in this subsidiary in exchange. So there's going to be FCS stock. So FCS stock is going to go back to ECI. Now, what ECI is going to do is the FCF stock, the flying car subsidiary stock, is going to go to the ECI shareholders, right? So the distributing corporation, they're giving assets to a subsidiary, and then they're getting stock back, and then that stock is being given to the distributing corporation's shareholders. So they're getting FCS, flying car subsidiary stock is being added to the ECI shareholders. So now the ECI shareholders, they own shares in Electric Cars Incorporated, and they own shares in Flying Cars subsidiary. So that's how a spinoff works. Now, if a spinoff is taxable, it would be taxed as a dividend. And that makes sense, right? So these shareholders are just sitting here, they own stock in ECI, and then this transaction happens, and now they get FCS stock. So it makes sense that if this is taxable, it would be taxed as a dividend. But again, it could qualify as non-taxable potentially under Section 355 and 368. Now, a split-off is somewhat similar to a spin-off. So I'm going to use the same firm here. So let's say, again, we've got Electric Cars Incorporated, and they've got these shareholders. And so they distribute assets to a subsidiary. So they distribute assets to a subsidiary, and in exchange, they receive stock, right? So they receive stock in that subsidiary, and then the stock is going to be given to the ECI shareholders. So they're going to get FCS stock. So you might be thinking, hey, how is this different than a spinoff? Well, here's the catch. Here's the catch. Some of these ECI shareholders are going to exchange. They're going to be giving up their ECI stock, right? So their stock in the distributing corporation, right? And again, I know this is confusing. Hang with me. So we've got the distributing corporation, which is Electric Cars Incorporated. I'm abbreviating as ECI. So ECI is giving assets to this subsidiary. They're saying, let's create this flying cars subsidiary. We'll give some assets, and then we'll have the subsidiary. And then they're getting stock, right, in FCS. They're giving that to the shareholders, but the shareholders are exchanging their ECI stock, some of it, not all of it, for FCS stock. So if we think about the net effect, is basically, we'll say some ECI stock is being given up or exchanged for FCS stock. So the ECI shareholders are they're giving up some of their stock in Electric Cars in exchange for stock in this subsidiary. Now, this could be pro rata, where every shareholder they're affected on a pro rata basis, or it could be non-pro rata, right? So you could have a situation where there's some kind of dispute over what to do with the assets of Electric Cars Incorporated, and you end up basically using this as a way to buy out or get, some shareholders that are like in two distinct camps and they're arguing about the direction of the firm and so forth. So you could have some kind of situation like that. Now, if this is taxable, and again, it doesn't have to be under Section 355 or 368, it could be non-taxable. You need to check the requirements to see. But if it were taxable, then it's going to be taxed as a stock redemption, not a dividend, right? It makes sense if you think about it. These ECI shareholders are giving up some of their current stock in order to get stock in this subsidiary, okay? Now, a split up is going to be probably the most different than the other two. It's in what you've got. So let's take this Electric Cars Incorporated again. So we've got this company and we decide, you know what? Actually, we're going to create two new companies. We're going to create Flying Cars Incorporated and Boring Cars Incorporated, right? So that's what we're going to do. We're going to create those two new companies, and then we're going to get rid of Electric Cars Incorporated. It's not going to exist anymore. We're done with it. So ECI shareholders, they're going to get stock in FCI. Let's see, Flying Cars Incorporated, FCI. I'm just abbreviating here. So they're going to get FCI stock. And then they're going to get stock in Boring Cars Incorporated. So we'll call that BCI. They're going to get BCI stock. But then they're going to get rid of their ECI stock. Because ECI isn't going to exist anymore. Maybe the brand for ECI wasn't good anymore and they want to create two fresh companies and start with a new leaf. So you've got Flying Cars and Boring Cars Incorporated, and you've got a split up. Now again, this could be a tax-free reorganization if it qualifies under Section 355 and 368. But if it's taxable, then this would be taxed to the shareholders as a liquidation of Electric Cars Incorporated.